it's certainly negative for oil demand growth. And the question is, how fast do the economies sort of stall and how that ripples through? There's lots of uncertainty of the impact of tariffs on sort of the US economy, the US consumer. We have we're revising our oil demand downwards, and a similar level to what you just mentioned for the EIA actually might well be stronger, as we're still reacting to the news that comes in, particularly with China's just recent announcement of 125% tariff on US goods. So China-US trade won't exist. We're looking at the US potentially tipping in towards a recession in Q1 next year, and this pulls down our oil demand expectations for both 2025 and also 2026.
Wow. Okay. So quite a downturn expected. What about China? How are you modeling the demand outlook in China right now? Clearly, they're going to take a hit from what's happening on the tariff front, but then at the same time, the Chinese authorities are quite keen to stimulate the domestic economy as best they can. We don't have a lot of clarity exactly on what that stimulus is going to look like and how far it's going to go, though. So how do you go about modeling the demand side?
You just mentioned all of the key uncertainties that we're trying to battle interface. So we've been looking, in a sense, our view on China's oil demands sort of go back a whole couple of weeks. We were thinking that Chinese demand for oil for transport had already peaked in 2024, and that actually was going to decline in 2025 because of LNG into trucking, electric vehicles for the passenger car fleet, but some modest growth in jet fuel supported by petrochemicals that lifted Chinese aggregate oil demand up for 2025 and 2026. Those petrochemical projects are likely slow. Some of them were based on US feedstock. The Chinese GDP growth will now be lower, so we are basically reducing our outlook for strength of oil demand in China. Some of it is acceleration of structural things I've mentioned. Others is just the implication of trade is for an export-driven economy is going to become more challenging. And some of the petrochemical projects were reliant on US feedstock. They have a decision to make as to whether they proceed. So it's very, very uncertain. There's lots of moving parts, but it's certainly downward for Chinese oil demand this year.
It's a pretty difficult outlook, it would seem, no matter how you cut it. Let me ask you about LNG, with President Trump floating the idea that the EU could buy more LNG from the U.S. as a way to appease or allay some of the grievances that President Trump has with the EU. He's sort of alluding to them buying up to $350 billion worth of LNG to even out what he sees as unfair trade balances. But just put it into context for us in terms of Europe's energy needs and what the actual scope is for Europe to buy more from the U.S.
There is the potential for Europe to buy more energy out of the US, LNG, sort of crude oil and refined products, because we import light crudes, we import diesel, we import gas. It's very hard, since the numbers that are being touted as potential are larger than the import requirements of the EU, negating the contracts that are already in place. So it's going to be very difficult for Europe to pivot very quickly, and to a challenge is, as Europe has learned to its cost, is becoming very reliant upon a single provider. So whilst it generates a good headline, it's hard to see Europe doing that quickly and the scale being enough to counter the significant trade deficit in goods between the EU and the US. So these are some of the things that we're looking at, but we're not expecting. We're expecting modest movements towards that aim, but not the scale that are being mentioned by the White House.